Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are undertaking a really critical deep dive into two massive and I think deeply interconnected forces that are reshaping the investment landscape right now.
Yeah, they really are.
And it's particularly important for anyone holding, speculative assets like cryptocurrency. On the surface, these two topics, they look completely separate.
Totally.
On one hand, you have this internal structural crisis facing companies that built their entire model around holding massive crypto reserves. We call them the D firms.
The crypto proxies, right?
Exactly. And then on the other hand, you have this huge macroeconomic shock that's starting halfway around the world. It's stemming from the Japanese yen and its, relentless collapse.
And that collapse is actively draining global dollar liquidity. That connection is absolutely key.
It is.
The data we've gathered shows this isn't just, your typical market volatility. We are witnessing fundamental structural changes. So for you, the investor, this really demands a shift in thinking.
A shift in how you think about crypto exposure.
A shift in how you access it, and maybe more importantly, where you look for the big macro signals that are going to predict market direction. So our mission today is to peel back these layers.
Okay.
Not just to understand why your risky assets might be struggling, but to really identify where the new durable opportunities might lie in all this change.
Absolutely. Our goal here is to take these deeply complex movements, the collapse of a business model on one side, the seizing up of global funding markets on the other, and just distill them into clear, actionable concepts.
And we'll use analogies, real-world examples.
We have to, because in finance, the raw numbers, they can mask the real story happening underneath. So let's start with those DAT firms, the former darlings of the stock market that acted as crypto proxies.
Right.
Okay, so for years, if you were a company, especially an institutional one with strict rules, and you wanted crypto exposure in a brokerage account, you didn't have many choices.
Very limited choices.
You had to go to these companies that were basically crypto holding vehicles, just sort of disguised as tech firms. The research material now suggests this whole model, which was once a guarantee of success, is now facing, you could call it an existential threat.
It really is. And to really set the context here, especially for beginner investors, we have to go back in time just a little bit.
Before the ETFs.
Exactly. Before the SEC approved the Bitcoin spot ETFs, these DK companies, like MicroStrategy, MSTR as the ticker, they were immensely valuable. They traded at a significant premium.
A huge premium sometimes.
Oh, yeah. Sometimes 20%, even 30% over the actual value, the net asset value, or an NAV, of the Bitcoin they held. And the reason was simple.
They were the gatekeepers.
They were the only game in town. If you wanted Bitcoin exposure in a traditional stock format, MSTR was your main vehicle. And that premium, well, that was the cost of accessibility, the price of convenience and compliance.
And the data shows that world is... it's officially over. We saw the core event, the ultimate signal of this shift, just recently.
November 14th.
Right. On November 14th, MSTR's stock traded below the net asset value of the Bitcoin it holds. This is what's known as the minus premium, or the NAV discount.
And the stock price, relative to the Bitcoin it held, hit a critical ratio of 0.98x.
Okay, so that number, 0.98x, it sounds small, just 2 cents on the dollar, but it's a huge deal.
It's not just a technical marker. It's a flashing red light. It's screaming a lack of confidence.
Yeah.
And we have to unpack the gravity of what the market is saying with that number, because it's devastating for really two main reasons.
Yeah, what's reason one?
First, the market is effectively valuing MSTR's core software business, the business intelligence tech that Michael Saylor originally ran, at zero.
Let's pause on that for a second, because I think a lot of people, especially newer investors, might not even realize MSTR does something other than hold Bitcoin.
That's a crucial point to make. It wasn't born as a Bitcoin fund.
Right. What is this software business that the market's now just completely ignoring?
MSTR was, and it technically still is, a significant player in business intelligence. Enterprise software. They sell analytical tools to huge corporations.
So it was a real company.
A very real cash-flowing software company with millions in revenue before Saylor shifted the treasury strategy. So for the market to look at that entire operational entity, the IP, the clients, the recurring revenue, and say, that's worth zero, that's not just harsh. It shows a complete and total focus on the crypto treasury and specifically the risk attached to it.
Wow. Okay, so the core business is worthless in the market's eyes. What's the second, you said, even darker thing that the 0.98x discount implies?
The second implication is that the market is actively subtracting the risk of the company's massive and, frankly, complex debt structure directly from its Bitcoin assets.
So they're pricing in the debt.
Aggressively. MSTR didn't buy all that Bitcoin with cash on hand. They used convertible bonds, other financial instruments. They took on massive leverage. So if you buy, say, $100 of MSTR stock, the market is basically assuming that $2 of that is going to get eaten up by future debt servicing or, potential liquidation costs.
So investors aren't just ignoring the business, they're actively penalizing the stock for its debt.
They are pricing in the risk of corporate default and debt management problems. It's a huge red flag.
It really clarifies the irony here. Before, the analogy was pretty simple, right? You were happy to pay, say, $1.10 for $1 worth of Bitcoin because you needed that stop access.
It was the price of admission.
But now the analogy is completely inverted. You can theoretically buy $1 worth of Bitcoin for 98 cents. You're getting a discount. But that discount, it comes with a gigantic flashing asterisk.
It's the ultimate poison chalice. That's a great way to put it. You get the underlying asset for cheaper, but do you implicitly swallow all the corporate risk, all the debt risk, all the operational risk of MSTR?
You're not just buying Bitcoin.
No. You become a leveraged bet on Michael Saylor's ability to manage their massive convertible debt schedule and, crucially, avoid a margin call. This discount, this extreme fear, it signals that the big money, institutional investors, are rapidly prioritizing simple transparency and security, which, of course, the ETFs now offer in spades.
Right, and that takes us right into the problem of leverage itself. It was, undeniably the rocket fuel for these companies in the 2020-2021 bull market. It let them acquire huge amounts of Bitcoin so fast, and their stock prices just exploded.
It was an incredible write-up.
But as the data now confirms, that same leverage is a merciless curse when the market turns sour.
It creates a structural pattern, something we call inverse leverage, and is brutally predictable.
Okay, break that down for us. What's inverse leverage?
Okay, so imagine Bitcoin, the actual underlying asset, drops 10% on a bad day. A rough day, but not catastrophic for crypto.
Happens all the time.
Exactly. These DAT stocks, they don't just drop 10%. They crash 20%, 30%. The volatility gets amplified sometimes 2 or 3 times over.
Why such an amplified crash, though? It seems really disproportionate.
It's driven by 2 primary fears, and they're both tied directly to the debt. First is the fear of margin calls.
The liquidation fear.
Right. A lot of these leveraged positions require collateral. As the Bitcoin price falls, the dollar value of that collateral also falls. This forces the company to either post more collateral, which is cash they might not have, or face liquidation.
Yeah.
And second, there's the long-term fear of just simple debt repayment.
That if the price doesn't go up, they can't pay it back.
Investors start to realize that if the crypto price just stagnates or falls consistently, the debt they use to buy the coins might become totally unmanageable. It's a fear-based feedback loop.
And this sounds like the perfect environment for sophisticated short sellers to come back into the game. We know some of the famous ones have moved on, but the analysis points to new hedge funds aggressively using this very specific, very clever arbitrage strategy.
The Bitcoin long, MSTR short.
Explain that. How does that work?
This is the pressure point that keeps that discount from closing up. It's a sophisticated trade that's essentially betting on the structural flaw of the proxy model itself.
Okay.
So these funds, they simultaneously buy Bitcoin, so they're long the asset, and at the same time, they sell MSTR shares short. They're betting the stock will go down.
Why do both?
Because they're targeting that gap, that persistent gap between the asset value and the stock price. So think about it. If Bitcoin goes up, they make money on their long Bitcoin position. But if MSTR stock doesn't rise fast enough to match it,
Which it might not because of that debt fear we just talked about.
exactly,
Yeah.
then they profit on their short MSTR position too. They can win both ways.
Yeah.
They're basically using MSTR's own structural weakness against it.
So they are essentially using MSTR's stock volatility and debt risk as a guaranteed source of short-term profit.
Precisely. And the strategy is self-fulfilling. It adds constant, persistent downward pressure on the stock because every time that arbitrage opportunity opens up, every time MSTR fails to keep pace, these funds rush in to sell it short. This makes MSTR a highly volatile, unpredictable, and frankly structurally flawed vehicle for the average retail investor who can't do this complex trade.
Right. You're left holding a stock that is constantly fighting institutional short pressure.
You are.
Okay, so we've focused heavily on MSTR, mostly because they're the biggest player. But they also hold mostly Bitcoin, which is, relatively stable in the crypto world.
Relatively, yes.
Let's talk about the other companies, the ones whose treasuries hold Ethereum, or even worse, baskets of less liquid altcoins. For them, the crisis is far more severe. The data suggests it's approaching an existential crisis.
The distinction is absolutely vital. Bitcoin, for all its volatility, has institutional liquidity. It has name recognition. You can sell large amounts without completely crashing the price.
Altcoins don't have that.
Most do not. So for companies that aggressively leveraged into altcoins, the pain is magnified exponentially. If their altcoin holdings drop dramatically, they face this phenomenon we call the death spiral.
Okay, let's get into that. How exactly does the spiral work? I think our listeners, especially the beginners, need a step-by-step on this.
Okay, so imagine Company A bought some hot altcoin at $100 last year during the bull run. Now that coin is trading at $30.
A huge loss.
A massive paper loss. And their balance sheet has to reflect that loss. If those losses get too big, they can violate their lending covenants.
And covenants are just rules set by the banks who lent them money.
Exactly. Rules that govern the health of the company's financials. If you break them, it immediately scares away any new investment and could trigger defaults. So to prevent this catastrophic balance sheet problem, they're forced into a terrible position.
You have to sell.
They have to sell assets even if the price is way below what they paid. It's a loss cut.
So they're forced to sell at a loss to stop an even bigger loss. It's that awful situation where you have to do something really painful just to prevent total ruin.
That's it exactly. They become forced sellers in an already weak and illiquid market. And this forced selling, it floods the altcoin market with supply. A single large seller can push a less liquid altcoin down significantly.
And I think I see where this is going.
What happens when that price drops even further?
It destroys the balance sheets of other companies holding the same coin.
Right. And those firms, in turn, are forced to sell to meet their own covenants.
So one company's necessary pain just accelerates the crisis for the next company, and it creates this horrible chain reaction.
It's a self-reinforcing catastrophic cycle. The selling drives prices down, which forces more selling, which drives prices down even more. It is incredibly difficult to break out of that loop, and it threatens the very solvency, the very existence of these highly leveraged altcoin proxy firms.
And that's why the data suggests that these pure coin-hoarding companies, especially those heavy on altcoins, they're facing extinction. They just can't escape that leverage compounded by forced liquidation.
Yeah, the model is broken.
Which leads to the unavoidable conclusion for investors. The era of the crypto proxy company is dying. Why would a smart investor willingly step into this minefield of debt and leverage and amplified volatility when there are now transparent, regulated, low-fee alternatives?
And that is the foundational insight. Insight number one, the ETF is the new normal.
Simple as that.
The successful launch and adoption of these Bitcoin spot ETFs, Abbott, FBTC, all the others, has structurally and permanently eliminated the main reason for investing in the DAT proxies. The ETFs are liquid, they're transparent, you know exactly what they hold, and they have very low management fees. They solve the access problem without adding all that corporate debt risk.
So holding a DAT stock now is basically a high-risk, low-return gamble, especially since they don't have that premium anymore.
Absolutely. If your goal as an investor is pure, direct exposure to the price of Bitcoin, the spot ETF is just the superior, safer, and structurally healthier way to do it.
Okay, but let's play devil's advocate for a minute. For the, sophisticated, seasoned investor who loves risk. Insight number two. If MSTR is trading at 0.98x NAV, you are, in theory, getting Bitcoin cheap.
In theory.
If the market eventually decides MSTR is solvent and Bitcoin recovers, couldn't the stock rise faster than Bitcoin itself by closing that 2% discount? Isn't that a buying opportunity?
It is, theoretically. But this is a high-level strategy. And I have to stress, for the average person, it is immensely dangerous.
Why so dangerous?
Because that arbitrage only works if you are absolutely confident that MSTR can navigate its massive debt obligations perfectly. Specifically, they have to avoid a forced liquidation event or a margin call during a sharp price slump. If MSTR stumbles on its debt management, if they ever have to sell Bitcoin at a loss to cover a debt payment, the stock will just collapse.
So trying to capture that tiny 2% discount is like picking up pennies in front of a steamroller.
Yeah, holding a sharp blade. You risk total capital loss for a really marginal potential benefit.
Okay, that makes sense. Which brings us to insight number three, the survivors. If the pure hoarder model is collapsing, what does a survivor look like? The data suggests they have to generate real cash flow.
That's the critical filter. The only companies in this space that will maintain long-term institutional interest are the ones that use blockchain technology to generate real, repeatable revenue streams that are independent of just the asset price going up.
Okay, so give us some examples.
We're looking at companies like Coinbase, which generates immense transaction fees. We're talking about highly efficient mining companies that can manage their operations and stay profitable even during bear markets. We were talking about payment and infrastructure firms, the pure coin hoarding model, the one that relies solely on price appreciation and dangerous leverage, has hit a wall.
And finally, a highly technical but really vital point for anyone looking at this sector. Insight number 4. It's about the 2025 Fair Value Accounting Standard, or FASB. You said this is a double-edged sword.
Right. So for years, the accounting rules were kind of weird for crypto. Companies had to use the lower of cost or market rule. This meant if Bitcoin went up, they couldn't show the profit on their balance sheet unless they sold. But if Bitcoin dropped, they had to report the loss immediately.
A total asymmetry that penalized holding.
Exactly. The new FASB standard changes this. Now, companies have to report the fair market value of their crypto assets every single quarter.
Okay, that sounds like a good thing. More transparency, right? But you called it a double-edged sword.
It is transparent, but it's brutally so. The implication is immense volatility in their earnings. The price fluctuations will now hit their quarterly net income figures directly.
Give us a quick example of that.
Okay, let's say a company bought $1 billion in Bitcoin, and Bitcoin drops 20% in one quarter. They now have to report a $200 million non-cash loss immediately on their income statement. Their statutory earnings for that quarter will look absolutely catastrophic.
Even if their actual business, their software or mining business, is generating healthy cash flow.
Correct. And massive earnings volatility like that is kryptonite for institutional investors. They want stability and reliable guidance.
They hate surprises.
It deters long-term holding, and it just makes quarterly reporting a circus. Therefore, investors have to recognize that traditional valuation metrics, like the price to earnings or PE ratio, are going to be wildly distorted and basically useless for these companies after 2025.
So what should they look at instead?
You have to ignore those reported net income figures and analyze the company based on its cash flow statement, the actual money flowing in and out of the business.
Yeah.
That's the only way to assess its true sustainable health.
So to wrap up this first deep dive, the MSTR discount hitting 0.98x is much more than just a market anomaly. It's a historical marker. It's signaling the definitive, permanent shift away from risky, indirect, leveraged crypto investment
and toward transparent, direct institutional investment through ETFs. The fantasy of easy leverage is over. Investors just need to embrace that reality.
Okay, so we've covered why the internal structures of this crypto proxy world are weakening, really collapsing under their own weight. But this micro weakness is colliding with a massive macro storm. Let's talk about the essential fuel for all risky assets, the dollar.
And we shift now to the macro threat that's putting a sort of structural glass ceiling on all risky assets. That includes the stock market and even those shiny new Bitcoin ETFs. We're talking about a severe tightening of global dollar liquidity.
And this whole crisis is being triggered by the relentless, profound weakness of the Japanese yen.
That's the epicenter.
The news flow around the yen, it's just been a relentless downward curve. Recently, we saw strong U.S. retail sales data, which signals that the U.S. economy is resilient and that reinforces demand for the dollar globally. And this strength pushed the dollar-yen rate temporarily past the critical level of 156 yen. It also showed that verbal intervention from Japan, officials just saying they might step in, has completely failed. The currency is in a runaway state.
And the data shows us exactly why Japan's hands are tied. The crucial domestic factor that's cementing this crisis was the recent report on Japan's Q3 GDP. It showed an unexpected minus growth, a contraction of 0.4%.
The economy is shrinking.
The economy is shrinking. This negative GDP shockwave gives undeniable justification for Japanese leadership, specifically Prime Minister Takaichi, to maintain their extremely loose monetary policy.
So they're caught between a rock and a hard place. They need a strong yen to stop inflation and capital flight, but they can't possibly raise interest rates if their economy is already shrinking.
Exactly. Raising rates now would likely send them into a full-blown recession. So this structural policy divergence is just cemented in place. The U.S. holds rates high, maintaining dollar demand, while the Bank of Japan, the BOJ, keeps rates near zero, which structurally weakens the yen.
So the market expectation is just locked in.
It's solidified. The BOJ will hold rates steady in December, guaranteeing the yen stays cheap.
And the analysis even suggests that geopolitics is adding accelerant to this fire. We've seen rising tensions around islands like the Senkakus, which is encouraging capital flight.
Geopolitical instability is a massive catalyst for wealthy individuals and large institutions. When there's friction, capital seeks safety. And right now, safety means dollars. It encourages foreign investors and, critically, wealthy Japanese domestic capital to actively move their money abroad for better returns and for security.
So that just accelerates the yen's decline even more.
It makes the BOJ's already impossible job even harder. This is a spiral driven by policy, economic weakness, and fear.
Okay, so that's the problem in Japan. Now connect that to the global financial plumbing.
Right, we need to shift our focus from Tokyo to the short-term lending markets that connect everything. The core relationship here is fundamental. When the yen gets this cheap, Japanese financial institutions, which hold massive dollar-denominated assets overseas, they desperately need to acquire more dollars, and they need them fast.
Okay, let's use that analogy you mentioned, the global financial ATM. If the yen is cheap, why does that trigger a rush to the ATM for dollars?
Think of the repo market, the repurchase agreement market, as the overnight lifeline for global finance. It's the big bank's ATM. They use this market to borrow cash, mostly dollars, using high-quality collateral like treasury bonds just overnight.
Okay.
Now, imagine a massive Japanese bank has, say, $100 billion in U.S. investments that are funded by yen debt. When the yen weakens dramatically, the collateral they posted, when you value it back in yen, is suddenly worth less. And more importantly, to maintain that massive dollar exposure, they have to constantly roll over short-term loans.
They need more dollars?
They have to rush to the ATM, the repo market, to borrow more dollars to cover their margin calls and keep their overseas positions safe.
And if too many of these massive banks are all trying to do this at the same time, the cost of borrowing those dollars just explodes.
It does. The ATM doesn't run out of cash necessarily, but it starts charging these exorbitant stress level fees. And we see this fee in the form of a key metric, the Secured Overnight Financing Rate, or SOFR.
And the warning signal is that SOFR recently spiked above the Federal Reserve's target benchmark.
That's the flashing red light.
Why is SOFR spiking above the Fed's target rate such a massive warning sign? I mean, for most people, they think rates just move where the Fed tells them to move.
Precisely. The Fed sets a target range. When the actual rate that banks charge each other overnight, SOF, moves above that range, it is an unambiguous sign of a systemic liquidity crunch. It means demand for borrowing dollars is exploding, but the supply of dollars available to lend overnight is constrained.
Or banks are just afraid to lend them out.
Or they're afraid to lend. This tightness signals that the entire global financial system is under stress, and the cost of capital is rapidly escalating for everyone.
And the analysis points directly to Japanese banks as the main drivers of this skyrocketing dollar demand. They are essentially hoarding dollars, paying any price.
They have to. Japanese institutions are aggressively buying dollars at a premium, which is why SOFR is high, for two main reasons. First, they need to cover the falling value of their collateral because the yen is so weak. And second, they have these vast, complex overseas investments, U.S. treasuries, European corporate debt, that need constant dollar funding.
So they're competing with everyone else in the world for these dollars.
They're competing aggressively with every hedge fund, every corporate treasury, every entity that needs short-term dollar loans. And that drives up the price of borrowing for absolutely everyone.
So it sounds like the Japanese yen crisis isn't just Japan's problem anymore. It's being exported globally through the dollar funding markets.
That's the perfect way to put it. Japan is exporting dollar tightness to the rest of the world.
Okay, so let's make the final connection. Why should someone holding Bitcoin or even a tech stock care about a bank in Tokyo rushing to borrow dollars?
Because cryptocurrency is arguably the most sensitive asset class there is to the availability and the cost of dollar liquidity.
It's the definition of a speculative asset. It relies on cheap, abundant capital.
Exactly. When capital is cheap, investors take risks. They move money out of conservative assets and into high-beta speculative bets like crypto. When capital gets expensive, that process reverses instantly.
And we can see the proof of this in the correlation data. Recent Bitcoin declines, while they're always accompanied by headline noise, maybe President Trump makes a comment about trade tariffs or there's regulatory uncertainty.
Right, it was always a narrative.
But fundamentally, Bitcoin's price has been tracking inversely with these rising dollar funding costs, specifically SOFR.
That's the core engine that matters. The political noise is the story they tell, but the cost of money is the reality. When the money tap, global dollar liquidity tightens, and the cost of borrowing goes up, funds instinctively retreat. And where do they pull back from first?
The most speculative, highest risk assets.
Always. Crypto's potential upward movement, regardless of good news like ETF inflows, is being structurally suppressed by this elevated cost structure. It's just simple arithmetic. If it costs significantly more to borrow dollars, fewer people are going to make speculative bets with those dollars.
So the ceiling on Bitcoin isn't really set by technical charts right now. It's set by the cost of global funding.
The cost of fuel dictates how high the rocket can fly. And right now, the fuel is very expensive.
Okay, this is critical stuff. Let's translate this sophisticated macro analysis into some actionable strategy for our beginner investors. Insight number 1. The most critical takeaway seems to be that crypto investors now have to look beyond the Bitcoin charts.
You have to.
You have to actively monitor foreign exchange charts, specifically the yen-dollar rate.
The yen-dollar pair has become a leading indicator for Bitcoin. It's that important. If yen weakness persists, which means the dollar-yen rate keeps climbing up towards 160A, then tight dollar conditions will act as a glass ceiling for crypto.
So what would it take for that ceiling to break?
True BTC relief requires one of two things: either explicit, successful intervention by the Japanese government to strengthen the yen, or the Federal Reserve stepping in to supply liquidity here in the U.S. Until one of those happens, the cost of capital just remains too high for a sustained, aggressive crypto rally.
Got it. Okay, insight number 2. Do not ignore the repo market warning. The general stock market, the S&P 500, it might look resilient, even stable right now, but the cracks in the funding market are a massive danger signal.
This is a signal that very few retail investors watch, but professional traders obsess over it. SOFR spikes are a sign of stress in the plumbing of the financial system. If that stress escalates, it could lead to a sudden, painful market seizure.
And we've seen this before.
We saw a dramatic example back in September of 2019. A liquidity shock in the repo market forced the Fed to intervene, and that ultimately forced a broad, sharp adjustment across all assets, including the stock market. You do not want to be caught unprepared for that kind of event.
So if the stock market looks fine, but SOFR is spiking, how should a beginner investor react? What's the concrete, actionable advice here?
Actionable advice. Monitor SOFR. It's tracked publicly by the New York Fed. If it remains persistently elevated, if it refuses to settle back down inside the Fed's target range, you should adopt a highly conservative strategy.
Meaning what? Go to cash.
It means increasing your cash reserves. This isn't about calling a crash. It's about preparation for a potential broad market correction triggered by a withdrawal of liquidity. And right now, cash is safety, and it earns a high yield. You should use SOFR as your thermometer for systemic risk.
That's a great way to think about it. Okay, finally, insight number 3. The market isn't just drifting, it's waiting for Japan's next move, which seems like the only thing that could break this vicious cycle.
We need to watch that boiling point. The analysis suggests that if the yen approaches that highly symbolic and psychological mark of 160, a level we haven't seen in decades, the Japanese government may be forced into an unavoidable, aggressive action.
And that action could be one of two things.
Right. It could be massive direct currency intervention, where they sell vast amounts of their dollar reserves to buy yen. Or the truly painful option, a sudden surprise rate hike, despite all their domestic recession fears.
Let's spend a moment on that, because that would be huge. If Japan raises rates, what happens to the legendary yen carry trade, and why is that a global shock?
The yen carry trade is one of the most significant forces in global finance. For years, big investors, hedge funds, major institutions have borrowed yen at near zero interest rates from Japan.
Because it's basically free money.
Basically free money. And then they take those cheap yen, they convert them to dollars or euros, and they invest in higher yielding assets all over the world. U.S. stocks, emerging market bonds, European real estate. They make money on that interest rate spread.
So they borrow at what, 0.1% and invest where they can get 5% or 6%?
Precisely. Now, if Japan suddenly raises its rates, say from 0.1% to just 1.5%, the math of that trade changes instantly. The cost of maintaining that loan skyrockets, and the risk-reward ratio flips on its head.
So everyone who borrowed that cheap yen has to unwind the trade.
They have a desperate need to unwind it. They have to sell their global assets, stocks, bonds, crypto, everything, and convert that money back into yen to repay the loan before their financing costs become unmanageable.
And that unwinding, that mass liquidation of global assets, would cause a monumental global market shock.
It would be seismic. You would see prices drop everywhere because of that forced selling. However, and this is key for investors, that shock would also signal the start of the yen's recovery, and crucially, dollar weakness, as all those dollars get sold to buy yen back.
So that moment, that sharp correction followed by the currency reversal, that's the turning point.
That would be the critical turning point investors have to be ready for. Patience until that moment is absolutely key. Trying to preempt it is just guessing.
Wow. Okay, that was a critical deep dive into two structural forces just dominating the market right now. First, the structural death of the leveraged crypto proxy model, signaled by that MSTR discount and the move toward transparent ETFs. And second, the global liquidity squeeze, driven by the seemingly unstoppable collapse of the yen, which is acting as a glass ceiling for all speculative assets.
And what the data tells us, at the end of the day, is that the old rules for engaging with speculative assets have changed permanently. Aggressive, leveraged risk-taking is just ill-advised right now.
The market's running a high fever.
It is. And the only reliable thermometers you have are those key global indicators, the yen exchange rate and the U.S. repo rates, specifically SOFR. My advice is to prioritize cash and use these metrics to guide your patience.
Wise words. Don't forget to subscribe and hit that like button.